Hello students, welcome to the series on advertising. Today we are going to study unit 1 and we will cover the determinants and the major methods of budgeting for advertising. Now let us first study the objective of the study. The basic objective of this lecture is to focus on the various methods of budgeting and the impact of fund allocation on the cost of business process. Now, in our previous lecture, we had studied the factors impacting the budgeting process. Now, we are going to study the specific methods adopted by various companies in the market. Now, let us first study this quote on advertising and money. According to Henry Ford, stopping advertising to save money is like stopping your watch to save time. So, advertising is essential, it is mandatory and is a part of business cost. It cannot be avoided because once you are making a product, it has to be known by the public, then only people can come to you and buy. So, advertising is a part and a process of product formation and product implementation itself. Now, the first method for advertising budgeting is the affordable method. Now, let us study this affordable method in details. Here the expenses are done in production, then leftover money is invested in advertisement. It believes that advertisement is an expenditure and there are no expectations for return on investment. This method is a philosophy of small businesses. Now, what is affordable method? Basically, businesses who are new and the businesses who are not having very accurate balance sheets or who are not having huge turnover, they have different methods to calculate their product cost and they have different methods which are little vague in terms, like they would invest in the production process and then whatever the money is left, they would invest in advertising. They do not believe like what is the investment, what is the return on the per unit invested. For them it becomes very essential that with their meager funds and their meager resources, they would invest in advertising on local basis and on the print basis to take their products to the audiences. So, this is how much the investor can afford and what he believes in the product launch would be his way of investing in advertising budgeting. Then is the second method is the arbitrary allocation. Here the decision depends on psychological and the economical minds of management people. There is no systematic thinking. No objectives have been budgeted for. Purpose of advertising and promotion are ignored. Now, arbitrary allocation is that on the basis of just your thinking and your logical aspects of believing in what would work in market and what would not work in market, you try to take out some funds and start investing in advertising. There is no systematic formula or there is no calculation done in costing and building up the product launch, but here the objectives of budgeting are also not decided. Here just a small amount of money on vague basis is separated and people because they are educated and they have a kind of a policy and a philosophy to believe in, and on the basis of their subjective thinking they invest on advertising. Now, the third method is the percentage of sales method. Now, this is based on sales of the product. Amount is fixed over here, the percentage of sales revenue is decided. It is easy to implement, it is financially safe and spending within the limits. The effect of sales into next year's forecast rather than relying on past data is important. It establishes relationship among promotion cost, selling price and profit per unit. So, what is percentage of sales method is the company would decide what are their sales forecast, that is what is the amount of products which are sold in the market, what is the per unit cost of the product and how much the per unit cost multiplied by the number of units sold will give them the revenue. Out of this revenue, they will fix certain percentage of money to be invested in advertising. Here the past data is not taken into consideration, but the future is anticipated, because that will be more relevant figure. Because the forecast in terms like how much we have invested, what is the demand in the market, because when we do production we obviously calculate the demand on the basis of the orders we receive. And now when we have received the orders and when we have started the production process, we would establish a relationship with our customers, and this would take into the production cost, the selling price of the products and the profits per unit. What is the profit per unit you would achieve? You would decide a percentage to be invested in advertising. Now, the percentage of sales method, here we have a simple formula to calculate it. First step is to assign a fixed amount of the unit product cost, then you multiply this by the number of units sold. First you must be able to calculate what is your cost for per unit. The per unit costing method would take into various factors of the fixed cost, the variable cost, the marketing cost and the other expenditures in terms of the labor cost involved, in terms of the money which you have taken from banks, the interest rate inclined to it. So, it is a tedious method where you take into all the financial concerns and then come to the per unit cost. The percentage of profit methods, in this the companies set their budget at a certain percentage of their current or forecasted profits. The changes in macroeconomic and the environmental factors like political, social, demographic, inflation, economic and legal factors, they impact the costing of the product. The cost component might change over time and across geography in the same industry. Now, the percentage of profits and percentage of sales per unit also varies from country to country and from industry to industry, and it has some problems when it is impacted by the changing political philosophies and the changing market factors in terms of taste and trends, which do happen in a very fast way. The cost of the production is impacted. So, here to anticipate these changes is difficult and the management faces problems. So, the biggest shortcoming of this method is that the changes which are happening very fast in the market would impact the formula for calculating the cost for advertising budgets. Now, let us study the unit of sale method. The consumer durable firms make use of this method as a variant on sales percentage. Here, fixed sum per unit of the product method is implied. Advertising of specialty goods with higher prices are actually impacted by it. Now, this fixed percentage is different in terms of the consumer durable goods and is different for specialty goods. Specialty goods are very costly. So, for this a fixed amount can be assigned and can be invested on advertising budget. But when you take FMCG products, then you have to take per unit product, per unit cost and then decide the advertising budget. Now, let us study the historical method of budgeting. This believes that there is no change taking place in the market growth is slow. The last year's budget could be multiplied by a factor to cover the media rate increase. Now, historical method basically assumes that the industry is same, it is not changing very fast, the market growth rate is slow. So, that you can take up the past trends. Past trends means the budgets can be taken up for the last year, they can be multiplied by some factor which would incorporate the media rate changes in the market, and a advertising budget on a rough basis can be estimated to be invested. The other method is the competitive parity method. This involves setting budgets to match the competitors' expenditures and funds. Here this method ignores that advertising needs to focus on objectives. Companies need to simply make products better than others. Now, the competitive parity method basically believes that how much your competitors in the industry are spending. The price war basically impacts all the partners or all the players in the market. Like when Jio came up with a marketing strategy and an advertising strategy of giving free services to the customers for 90 rupees, then it was a big shake to the other players also in the market. The other players like Airtel, Vodafone and Idea were forced to reduce their prices and come up with aggressive marketing strategies to stop their market share to be reduced. So, when the industry is impacted by competition in a big way, it shakes all the other people who are working in the market. So, most of the advertising budget which would have been uniform otherwise if Jio was not launched, but because suddenly a kind of a sudden impact in the market came. So, all the prices and all the advertising, the funding, the budgeting changed for the other people also. But this method basically ignores the fact that you are not deciding on your own advertising budget and you are not deciding on your own services and the product quality, but you are influenced by your competitors. So, this method is not a very quality based, where each individual needs to stand by their own methods of calculation and cost to get a particular share in the market. Then is the return on investment method for budgeting. This method says that advertising basically causes sales. In the marginal analysis and S-shaped curve approaches of economics, we believe that increase in advertisement budgets may lead to increase in sales. In the ROI, that is the return on investment budgeting method, advertising and promotions are considered as investments like plant and equipment. Now, when we take up economics and try to study the marginal analysis, we say as you increase the cost of the production, the quality would increase. So, same as you would increase the advertising budgets, your sales would increase. This is the belief. But return on investment method believes that advertising is not an expenditure, but it is an investment which you done on factories, that is the land, layout, equipment, machines which are like assets. So, advertising budget in very long term would become an asset, because a brand which is intangible can give you a valuation of crores of rupees whether the organization is in losses or is in profit. You can take the example of Flipkart, a name which became household, but an organization which was in losses, but still the brand valuation was very high. So, this brand was purchased for millions of dollars by big companies like Walmart. They can make the operational efficiencies better, but to create a household name requires years and collection of data in a tedious way. So, brand itself is a wealth. Then let us study the Vidal and Wolfe's model. This model says there should be a larger advertising budget, higher in sales response rate. So, higher is the sales decays rates also. Customers forget that advertising and brand ad, this leads to a higher untapped sales potential. Now, what is this? This method says that advertising budget basically has to be large and it has to be consistent in terms, because when the customers know your brands, then there are group of people who would forget you and would switch to the other brands also. So, this is a constant process of creating and decaying customers. There would be new customers added to you and there would be customers who would be switching to the other brand. So, if all the customers switch, then you will be not left with the customers. So, constant process of finding, believing, building customers should be a process for all the companies, because this method believes that there is still untapped potential in the market, where you can always tap new customers. That is, if you can reduce prices, you can go to the other segments. Then there is, if you can create speciality and creative products, you can go for niche marketing. So, it is a constant process of tapping the market potential to build advertising. Now, let us study the other method of advertising budgeting. This is known as the compromise model. Here the professionals blend some well accepted methods and arrive at a compromise budget as a logical approach. The budget basically depends on target audience, size of the audience and location, the media available, the combinations of media channels available, the campaign quality decided, the frequency of advertisement decided. Now, what is the compromise method? Because no method is very accurate, every method has some shortcomings and some kind of basic flaws associated, which makes it very complex. So, the learned professionals would combine various methods to derive a logical sum on the activity which they have created, that is the ad campaigns, the quality, the target, the audiences and the media rates would decide what is the budget they would invest for a particular market audience. Now, let us study this other method which is known as the John Little model of advertising budget. This method is an adaptive control method for setting the advertising budget. Advertising expenditure rate is based on its most current information. Now, this is basically adaptive method which changes from year to year. What are the current rates which are changing? See, there are seasons for every activity. The rates for those things go high, and so the channels would charge you higher when you are promoting your products in Diwali season, or the political campaigns will be costly when you are going for the election, or the hospitality and the hotel rates would be higher in the peak seasons, but they could go as low as 1/4 in off season. So, advertising budgeting would be low in off seasons, would be very high in peak seasons. So, what is the current information, what is the current trend which is impacting the market, on the basis of that the advertising budget would be decided. Like if you have football match like World Cup match happening, this is the time when most of the airlines could go for marketing, this is the time when most of the sponsor companies related to sports can go for good advertising and sell their products in the market in a big way. So, when there are seasons like if there is carnival, most of the production houses, they are not left with any goods also, because everybody is demanding new products in the market. Now, let us study this other method which is known as the total group budget. This is possible when you have multi-location and multi-product line firms. A total amount of advertising is decided to build the group image, then each strategic business unit receives a share according to their needs. Now, what is total group budget? You have very large companies who would not invest in individual products, because individual products may be more than 100 products lines working in those companies. So, this group basically focuses on the corporate image or the group image. Like if you have a Tata product, Tata itself would market its own brand name, and this image goes to decide the quality and the branding for the other products also. Then you have Tetley tea, then you have airlines, you have cars, you have hotels, you have so many things associated with this brand, that each advertising would be important, but more important is the group image advertising. So, this would cost you higher budgets, and then according to each location and each product the budget would be decided. Now, let us study the operational modeling for advertising budgeting. Market research helps in deciding the advertising expenses. Market response and sales per advertising figures through modeling is done to build budgets. Now, market research is important because now the data collection through ads and through channels and the sales which you achieve, they are all mined, that is the data is mined and the classification is done. Classification through softwares which would tell you that which celebrity would influence the market and tilt the sales and would tilt the figures towards their products and services. So, this approach would tell you what is the per unit which is sold, what is the cost, and how the celebrities can give you large turnover in the market. See, if you are investing in entertainment industry, so the sure bet is that if you take celebrities like Amir Khan, Salman Khan or Shah Rukh Khan, they are moving industries in themselves. They know that if they are going to endorse a film and make a entertainment out of this film, this would somewhere churn a figure of more than 300 crores in the market, which is not possible for any newcomer. So, they are already established people, they are already experts in the industry who have a figure to be given to the market. So, on the basis of that, like what will be your per unit cost, we could go for investment and decide our advertising budgets. So, there are successful celebrities and successful people in the industry who have their budgets decided, and these budgets do not fail in the market because it is pure market research and anticipation that you get a fixed return on this kind of investment. Now, let us study the composite method. In this method, the factors which are used are firm's past sales, future sales projection, production capacity, market environment and sales problems. Now, see, if you increase your advertising budget and you take it to the global channel or to the national level, and if you do not have a production capacity, it is a huge waste of money. So, we are going to advertise our goods and services only to a level where our production capacity is utilized. If I have a factory which can produce only 2 trucks per day, how you can advertise it for selling 5 trucks when your production capacity is only to manufacture 2 trucks per day. So, this is important that the composite method would take the sales problems also, would take their own production capacity problems also, and according to that you are going to invest on advertising. You are not going to over budget your advertising process, which is useless and which would cause frustrations in the market and which would also give you negative image. If you promise to sell a product in the market and you are not able to deliver, it will be a more harm to your image. So, we have to decide what is our potential, and according to that potential we are going to advertise. The composite method basically believes that the efficiency level of the sales personnel is important, the seasonality of the market is important, the regional considerations are important, the changing media scenario is important, and the changing media impact on the target market sector is needed to build the trends which results in advertising budgeting. So, this composite method would take all the factors associated with the production problems and the media problems, like what are the channel problems, what are the channel wars, how can we negotiate with the channels, go for a year round consistent budgeting rather than over utilizing particular only one channel, and then believing that your publicity through good work, through word of mouth can also play wonders in the market. The other method is the incremental approach for budgeting. Businesses maximize its profit at that point where the incremental cost is equal to incremental revenue. Advertisers can keep on increasing the advertisement budget to the extent where the last unit spent on advertising is equal to the net profit contribution by additional sales generation from the promotion. Now, what is incremental method is, see, each unit of money which you invest has to give you added incremental profit. This happens in the production where you have economies of scales generated, but economies of scales would also work till a level, because after one level where your fixed cost is free and when your variable cost also becomes minimum, there will be a point where the economies of scales will start degenerating and give you losses, because the growth and the diversification and the kind of the spread of operational cost which you have taken to the market would increase suddenly, because to handle an audience beyond certain level is difficult. So, again the businesses from that spreading and the diversification mode move to the consolidation phase. What is consolidation phase is like you are going for mergers, you are going for takeovers where you are merging the banks. Like recently the government adopted the strategy of merging 7 different banks together under a big banner. So, that was basically to reduce the operational cost which goes beyond managing the cost, as you need employees for each and every aspect. So, the marketing would be different with a different brand name and the operational cost would go beyond your control. So, after one phase where you are diversifying, growing, reaching the audiences by increasing the investment in the banking sector, but after a phase there will be a level where there will be losses. So, we need to consolidate. Same as advertising. Advertising expenditures are not infinite. There is a level where you get returns, and after that level we need to consolidate and build a kind of a figure which is reasonable and which is giving you returns. Now, let us study the summary. There are many methods of budgeting, but still the process of fund allocation for advertising depends on the management policy and the nature of the industry. The type of product and phase of development also impacts the advertising process. Now, because there are various methods of deciding advertising budgets available in the market, but each method has some flaw or some shortcoming. So, it would be the intelligence of the management minds, and it would be the research of the marketers which will impact the selection of the method, and a combination of all approaches can give you a logical deal to negotiate with the channels in the industry. I hope the students must have understood the budgeting methods in details. Thank you.